I would like now to switch to a very interesting, to my mind, model, which is called Integrated Model of Growth, again by Boston Consulting Group. And it's focused on the drivers of total shareholder return, which is TSR, very popular metric in the world of investors on the capital market. The model is called integrated because it describes at first fundamental value drivers and how they change over the time period. It also deals with the free cash flows and how they are used for which particular purposes. And it also encompasses expectations of the investors because it looks at some market multiples. So when you are looking at all these three different areas of metrics of the company, you should understand that, of course, they will describe the dynamic value creation system because any change in one of the particular metrics in fundamental value or free cash flows and their usage or in the multiples will affect the other group of metrics. They are all interrelated. That's why it's really very important to understand the linkages between these metrics and the drivers behind them. And when looking within some samples, within some periods, you will get the trends, you will pick up the most important drivers, and then that particular model could be also used to forecast some nearest future and anticipate the combining complex impact of all these drivers behind these three components, how they will interact in the nearest future. And the model also assumes that there would be some particular trade-offs for the management team, and they will be also discussed a little bit later in our course. So, to remind you total shareholder return, I'm writing here, following the logic of BCG, that metric in details. You see here that the total shareholder return, when you compute it, it should be based on dividends that investors expect, the cash dividends first, and of course, share repurchase as the overall total big one, dividend in some point in time of the company. Remember, in the corporate finance course, we discussed the dividend policy and we look through the direct cash dividends as well as through share repurchase and their role and their perceptions by the investors. And the second benefit stream is so-called capital gain, which is the difference between the market prices as described here in that picture per share, the price at the period T when you just bought that particular share of company stock, and at some future period of time, the price has changed. If it increased, you will get a gain. If it doesn't increase, if it decreased, you will not gain any. You will not get any gain. So that's why, due to that description by BCG consultants, the capital gain is a component when computing TSR is a type of early warning signal because it's easily compatible to some other companies. The higher the gain, the more attractive could be the share of that particular company, and vice versa, means that the lower the gain, or even if the gain is zero, or even it could be even negative, then it would be capital loss, but not the gain. It's also the warning, of course, signal about some poor processes in value creation, some particular company. Gain plus dividend or plus dividend income for the investor should be divided by the price at the point when the investor bought the stock at the beginning of the period. So we now see that the capital gain becomes also very important. And in some national reporting standards, capital gain must be reported by the investors, and it would be also taxed at some income tax rate. And the dividends are very evident. They also appear openly in the market, and it's really hard to manipulate by this particular component of TSR analysis. So all the variables which are included into the computation of TSR, they are easily observable and they are really very competitive. And that's why BCG group, of course, considers TSR as a metric, as being very comprehensive ratio. The overall model states that there are some linkages across all these particular drivers, and the TSR, of course, is driven by the capital gains, and the capital gains themselves rely on the growth of the earnings before interest, tax, depreciation, and amortization expense, because EBITDA is the closest parameter for the operational cash flow of any company in the world of investment analytics. And EBITDA multiple, which measures the perception how much investor is going to pay for each unit of EBITDA generated by the company. On the other side of the coin, TSR depends on the free cash flow yield. Free cash flow yield describes the interaction of the ways the company is going to use or already used the free cash flow which company generated in the past or is going to generate in the near future. The first direction, how the free cash flow would be used, of course, is going to say something about the dividend payments from the free cash flow produced by the company. So the dividend yield, which is the dividend to price per share coefficient, will describe the dividend payout policy of any company, which will fix for the investor the first type of usage of free cash flows generated by the company. The second type of usage could be, of course, related to the share repurchases as another way to pay for the investors, to the investors. So how much money the company is going to spend or spent in the past already for the share repurchase is also very important information for any investor, and the history of those share repurchases is tightly observed by any analyst and by regular investors in the market. Finally, last but not the least, the free cash flows of the company, of course, should be used to repay the company's debt, especially long-term debts of any company. So how much of free cash flow the company is using for debt repayments and how successful are those debt repayments, meaning the company has repaid the debt and then immediately can get another new debt on the regular basis. So the change in the debt of the company also is very meaningful to understand the drivers behind the TSR of the company. Moving forward, we can also give additional picture for these drivers, and the capital gain, as we already mentioned, depends on the growth of the EBITDA, which is the parameter which is close to the operation cash flow of the company. And of course, EBITDA itself depends on the sales growth rate of the company and on the EBITDA margin. When you compare EBITDA is in numerator to the sales revenue in denominator. So the change in EBITDA margin is also a very meaningful variable to understand the future perspective for TSR of any company. The multiple based on EBITDA is a description of the expectations of the investors. Of course, the multiple also is a function of some growth variables, growth rates in profits, growth rates in EBITDA margin, growth rates in sales growth, all other profitability variables. And there would be some so-called fade period of variables. So how those profitability margins are behaving themselves. Are they really stable? Are they increasing? Are they declining? And the fade period, according to BCG, means that this is the period for the stable rates of return and profitability margins of the company, and the investor can become really aware, more certain about the potential fade period when those margins will be predetermined by the investors. They will be much more clear for the investors within this fade period. There would be less uncertainty in the levels and the behavior of this margin within this fade period. So that's why fade period, of course, matters, and it depends on itself on some variables which are really important. And of course, EBITDA multiple depends on the risk variable. So this is a meaningful, comprehensive system of different drivers on different levels and their interactions. But finally, the integrated model for growth analysis is described by BCG consultants as consisted of three different steps. On the first step, two fundamental value creation variables on the focus on the agenda. The sales growth, how it's changed in the percentage terms, and the change in profitability margin, which is EBITDA margin. If you compare the change in the sales growth with the change in profit margin, you will get understanding in the change of EBITDA growth rates. The second step would be analysis of the market expectations which are captured by the market multiple. And BCG consultants, they prefer to use the multiple based on the EBITDA. So enterprise value, EV, in numerator divided by the EBITDA. This is a very important multiple showing the perceptions of the power of EBITDA as a driver behind the value of the company. So the change in that particular multiple is really very important metric that is proved by the history of integrated model for growth analysis by BCG group and the applied research results. And the third step would be analysis of the free cash flow use, the change in dividend yield, the change in the amount of shares, because the company is going to use some money for some share repurchases in case it does run these share repurchases instead of simple direct dividend cash payments, and the net debt change in percentage terms. So these three variables in block 3 in that logical picture will describe the free cash flow yield introduced by BCG in the model. And the market multiples, along with the fundamental value block of variables, is going to describe and to forecast capital gain change in percentage terms. So this is the overall logic of the model, which says all variables interact with each other. And these three blocks are very important. And observing the data, which is picked up at that particular slide in all three boxes, across some periods, among the companies, across the industries, you will get, following that logic, very interesting smart picture, which industries rely on which particular variables and drivers of the value more or less, what is the difference between different industries in terms of the power of variables behind TSR, behind the components of TSR, how the industries are differing in terms of the TSR drivers. Why it's important to understand from the past, because then it gives you some power to predict, to forecast how these drivers can behave in the nearest future, and then they will predetermine the TSR for the overall industries and, of course, the TSR for particular concrete firms inside these industries. I would highly and strongly recommend you then in our practical seminars to look through the web page of BCG group because you will get here a huge data of observations, at least for more than 20 years for different countries, for different industries. And of course, the industrial profile within this long 20 years period has changed, that's for sure. But you will see these new trends and you will get additional data about the drivers behind the industries and the drivers behind the most important players, companies within each industry worldwide. So this is a very powerful data set, I would say, because of the logic that is behind. And it's really very important for value-based business analytics. So how the model could be implemented? So collecting the data on these variables and running that analysis, building the econometrical set of data, trying to understand the significance of different variables and how they changed within some periods of observation, you will go through the step number 1, because then you will get the picture of the drivers of TSR and the relative strengths relative to each other, how they predetermine the TSR of that particular company or your competitors within your industry or across the industries. Again, this is a benchmarking exercise if you want. The next step, of course, you are planning for the future. You are trying to develop your value creation strategy. And that's why in the second stage, you need to establish some targets for each particular variable, for each particular driver, for your TSR in the nearest future. And of course, when you are trying to understand which particular interaction of future near-term drivers of the TSR you should expect, then on the third stage, you will need to ask your question whether your current business model and current asset structure and current model, how to generate enough cash flows really fit to the targets which are established for TSR and TSR drivers. So without reaching the TSR target drivers, you will not get overall TSR target for your company. That's the first lesson of that integrated model of the company growth. So let's now go into some details for each step. In the first step, you are identifying the drivers of TSR and their relative power to explain the TSR within your industry and of your particular company. And it will help you to find the key determinants that drive the value within this industry and for your concrete company. And then you need also to identify the so-called dominant investor group which prevails for your company. I will show you in a few minutes how BCG consultants classify the investor groups and their perceptions and their expectations. But bear in mind now at the first step that it's really very important to understand what your type of investors basis background, the dominating investor type is expecting from the company, because those investor groups could be really very, very different in their target expectations about that future of this particular company. On the step number 2, you need to find how the TSR for some current action program of your company growth is going to change. Because Any investments will, of course, impact the sales revenue. They will impact your expenses. They will influence, therefore, your EBITDA margins. So you need to understand all these interactions and all the changes, because you already set up the target for TSR, and then you will need the targets for the TSR drivers, and you will need to understand all the changes in your current growth program that you need to implement. On the step number 3, this is going to happen, this implementation of value growth strategies. And of course, it will also be connected to some remuneration policy, to some bonus or benefit planning for your executive team. About this particular very important aspect of value-based management, we will discuss it later. Separately, we'll be focusing on this, and our business expert, Andrei Marchenko, is going to show his own perception, because he has vast experience running different investment funds here in Russia and internationally. And now he's a partner of Sinai Capital Fund, and he will be showing you in a separate part of that topic the benefit planning approaches and their trade-offs for the management team.